In this training session, we will discuss the way the software handles loans from lending institutions and loans to customers. The software will calculate loan repayment schedules and automatically create accounts payable or accounts receivable invoices for individual payments. To access the loan program, select Loans from the General Ledger main menu. In this window, we can view all the existing loans we have from lenders and all the loans we have issued to our customers. We'll first discuss loans from lenders. In the list box, we see some summary information about our loan, including who we borrowed from, how much we borrowed, and the interest rate. We'll add another loan by clicking the Insert button. On this screen, we can enter a new loan. First, we give the loan a description. Now we can use the loan calculator fields to show us what our monthly payment will be, or to calculate how much we can borrow given a set monthly payment amount and interest rate. We'll start by entering the amount we wish to borrow, the interest rate offered by the lender, and the number of months we will be given to repay the loan. Once we have filled these fields, we can click the Calculate button next to the monthly payment field. The system calculates how much our combined principal and interest payments will be each month in order to pay off the loan balance within the allotted time frame. Now we can experiment with any of the three top figures and recalculate our monthly payment accordingly. We can also start from the bottom and indicate how much we are able to pay per month. We can then calculate the loan amount field based on how much we are able to pay. We can now enter loan-specific information such as the loan origination and due date, the general ledger liability account for the loan, which is usually long-term notes, the GL expense account for the interest payments, the vendor ID of our lending institution, and the lender's loan number. Now we'll select the Payment Schedule tab. Here we can instruct the system to create a schedule of our loan payments. Simply click the Create Payment Schedule button. The system creates a list of equal payment amounts equal in number to the loan term in months. As we scroll down through the payments, we see that the system has split each payment into a principal portion and an interest portion. We can now pay back the loan according to this schedule. Each month, when we create an accounts payable invoice for the loan payment, the system will automatically create one invoice line item for the principal payment and one line item for the interest payment. There may be months when we wish to add extra principal to our loan payment. Each time we choose to add principal, we decrease the amount of interest required on subsequent payments and shorten the term of the loan. The software will easily accommodate this practice. If we wish to add principal to any given payment, we click the Change button and simply enter the additional principal amount. When we click OK, the system will recalculate the principal and interest portions of all the subsequent payments, decreasing, in the end, the total amount of our combined principal and interest payments by the end of the loan term. Let's try this and see just how dramatic the savings can be. We'll start by borrowing a large sum of money with payments spread over a long period of time. This is common with mortgage loans. We'll borrow $300,000 at an interest rate of 6% and spread our payments over 30 years or 360 months. The system informs us that our monthly payment is $1,798.65. Now we'll go create a new payment schedule. According to our payment schedule, over 30 years we will pay off our principal of $300,000, but we will also pay over $347,000 in interest, making our total payments in excess of over $640,000. What will happen to these numbers if we commit to paying an extra $100 principal each month? Well, let's click on the Change button and indicate that we wish to pay an extra $100 of principal on each payment. The payment schedule is recalculated accordingly. Now we see that over the life of the loan, we will still pay off our principal, but we will only pay $294,000 in interest, a savings of roughly $50,000. We will also pay off the loan ahead of time. If we scroll through our payments, we find that the loan is paid off by payment number 313 out of 360. That means we will pay off our loan approximately 4 years early, simply by paying $18.98 per month instead of $17.98. Now we'll click OK to save our loan. Here we can see our loan included in the list box. Each month, we will need to post an accounts payable invoice to make a payment on each of our loans. The program can create these invoices automatically by clicking on the Create AP Invoices button. Here we see a list of the next few fiscal periods. As we click on each fiscal period, we see a list of the loan payments that will need to be made during that period. Each loan for which a payment should be made during the period is shown in this list box. Once again, at this point we can add additional principal to any of our loan payments. Now we specify which accounts payable invoice batch we wish to place our invoices in. Click the Proceed button, and the system will create the invoices in the selected batch. At this point, we can close our loan payment window and select Invoices from the Accounts Payable menu. We then select the appropriate batch, and we can see our loan payment invoices. When we click Change to view one of our invoices, we see that the system has created 2 invoice line items. The principal amount will be charged to the liability account, decreasing our loan liability, and the interest amount will be charged to our interest expense account. Now let's go back to the Loans menu option on the General Ledger main menu. This time we will look at loans to customers. When we click Insert, we see that the information required here is identical to the screen we previously discussed, with a few exceptions. In this case, we are required to provide an asset account for loans receivable and an interest income account. Also, we can select a customer to whom we will lend the money. The rest of the controls on these 2 tabs are the same as the ones discussed earlier. In the case of loans to customers, we can click the Create AR Billings button, and the system will allow us to create a batch of accounts receivable invoices. This operates in the same manner as the creation of accounts payable invoices, with one exception. We do not have the option to add principal to these payments. If the customer chooses to add principal to their payments, you will not know this until you receive the money. If this is the case, there are a couple of steps you should follow to account properly for the additional principal payment. First, you must manually create an accounts receivable trade invoice for the amount of the additional principal charged to the loans receivable account, not to your income account. Second, you must come to this point in the loans program and select the loan in question. On the Payment Schedule tab, select the appropriate month and click Change, then select Highlighted. Type in the additional principal amount received from the customer here. The system will recalculate all subsequent payments in the payment schedule. As you can see, this robust loan tracking program is very powerful, yet easy to use. This ends this training session on General Ledger Loans.